All right. This lesson is on order blocks as part of the price action series. Order blocks are a simple concept, and that's, in my opinion, why they are so valuable. They've been popularized through trading education, and you might see them used with fancy words like institutions and algorithmic. Mostly, this is just marketing and trying to repackage an old concept to seem like something new. Order blocks represent supply and demand in a simple, logical way. That's all. You don't want to seek complexity for the sake of it. What is an order block? An order block is simply a candlestick, a single candlestick, depending on what time frame you're trading. And it's a candlestick, as you see on the screen here, that represents the total range of buying and selling for a specific time period. So inside a candle, you'll have buyers and sellers expressing their opinions at different prices. An order block is simply a candlestick that comes directly before an impulse move up or down, and it's a move that produces a break of structure. So you'll know this from the trend lessons. That would be a continuation of a trend, or a market structure break if it's a trend shift. Here we have a bullish and a bearish order block. So I'll talk about them both individually. And because markets are fractal in nature, I want to note at this point that order blocks will occur on all time frames. So, first thing, you must remember, the time frame that it plays out on is the time frame that it will occur on. You don't want to try and take an order block from one time frame and expect a totally different move on a higher or even a lower time frame to play out, right? If you chart it on a 1 hour, expect it to play out on a 1 hour. If you chart it on a 15-minute chart, expect it to play out on that chart. So why does this matter? Because of what the order block represents. In an order block, you find the level before a break of structure. So if we look at the bullish one first, the order block is marked in green. It is drawn around the candlestick that directly precedes the break of structure. Now, a break of structure, as you know from the market structure lessons, is the highest close, so it's the swing high before the next leg of the trend. So we had a swing high, price went down a little bit, it then found its feet, it found some support, then it broke higher. In this candle, a break of structure was confirmed, and that made this the order block. You also have, which is going to occur in uptrends and downtrends, you also have key highs or key lows, which represent liquidity levels. It's an important distinction to make. The break of structure is where your actual trend confirmation comes from. But also, the market moves to areas of high liquidity. So, you want to view both, have them both marked, but understand that to actually confirm an order block, you must see a break of structure, BOS. So, the bullish order block produces a break of structure. That then leads to a break above liquidity. And the order block itself is a level that, if revisited, you should expect to see a reaction on that same time frame. That's simple. That's all it is. And that's how they work. Right? On the bearish side, we have exact same principle, just reversed. We have a bearish order block here, marked in red. We have a break of structure whenever price goes below the swing low of this consolidation. Remember, the break of structure comes from candle closes only. Ignore all the wicks. When it closes, when this candle closes below the break of structure level, the structure level, it is confirmed. This becomes the order block. And as you see again, there was also liquidity below that. Price went down through both of them. And in this example, you can see the main use of an order block. It revisits it, finds more resistance, more supply comes in, and it sells off. When it comes time to trading them, which I will cover in future lessons, this is what you're looking for. You're looking for high probability areas for a reaction to take place. That's all. That's what an order block is. Simple as that. Okay? Because this order block, this was the last attempt for the market to push higher, right? This was an up candle. So the last attempt for the market to push higher before a strong breakdown. that took out a break of structure and took out liquidity. So when we revisit that area, which obviously had a lot of buying and selling, and then the sellers won, your assumption is that when we go back there on the first retest, the sellers should also have a strong hand. Much like on the other side, although this example doesn't show it retesting that, future lessons will. That's it. Those are order blocks. That's what they're used for. That's how you find them on the chart. That's how you mark them. Now, there are many ways we can use them. We can use order blocks for trend continuation, trend termination, or to gauge the quality of demand or supply in a market. In the next lesson, we're going to go into those and explain them in a little bit more detail